Today's topic is statement of changes in equity. What is statement of changes in equity? We all are aware of that in statement of financial position, yani balance sheet, have assets, liabilities, and capital. And during our studies of company accounts, we are aware of that in the company, the capital has too many items. Capital has too many features. Number one, share capital. Number two, share premium. Number three, retain earning. Number four, revaluation reserve. Number five, other reserves. So, in order to know that what are the movements, what are the movements in the equity of a limited liability company, equity movement for a limited liability company, we are using a statement. This statement is called statement of changes in equity. This is chapter 20. Now,
Okay.
the statement of changes in equity. What? Why statement of changes in equity? So, the statement of changes in equity helps investors, stakeholders to understand how a company's equity position has changed over time. It provides insight into the sources of equity growth or decline in the distribution of profits to the shareholder. The statement of changes in equity is a simple summary of equity side for a limited liability company. How to produce this? Like we have a format for income statement, we have a format of a statement of financial position, which is a balance sheet. So we do have a format for statement of changes in equity. It's a column format. It's a column format. You need to memorize the format. The first column is shares capital. Second column is shares premium. Then we do have retained earnings. After retained earnings, we have next column which is called revaluation reserve. After retained earning, there's a column called revaluation reserves, any revaluation. Then we will have any other reserves. Any other reserves, it can be general reserve, it can be capital asset purchase reserve, it can be combined reserve. Other reserve means any other name. You named it, but it should be a reserve. It should be reserve, whatever the name it can be, but it must be a reserve. So one, two, three, four, five, mainly five columns. And lastly, our favorite column, which is total column. So this is a small format of what you call the small format of statement of changes in equity. Now these are the columns. Let me complete the columns. Column 1, column 2 is coming up. Let me draw the lines. Let them look nice. Two columns. Column 3, Mr. 4, and lastly, column total. Just I draw the format. This is the main format of the statement of changes in equity. Now, how to put items here? How to put, how to post things here? We are now going to learn. Okay. So the format continues. The first thing will be the opening balances. The first thing will be the opening balances, which is balance BD. BD means opening balance. So we do have opening balances, and these balances will be given to you in any question. After that, we learned issuance of shares. If I revise, if I recall what we learned, the entry for issuance of shares is bank debit, share capital credit, share premium also credit. So, because of issuance of shares, share capital and share premium both are going to increase because equity increases on credit side. So, because of issuance of shares, share capital and share premium both are coming on the credit side. Means equity increasing, and equity increases on credit side. So that's the first one. Second one, what we learned was right issue. Issuance of right shares. Right issue or issuance of right shares. The same entry, bank debit, share capital and share premium both credit. Means because of right shares, the equity is going to increase. The next thing is bonus shares. If you remember, or if I recall the entry for bonus shares, the entry is supposed to be share capital credit means equity increasing. Share capital credit means share capital is increasing. But in the case of bonus shares, we have two debits. The first preference of debit is right share premium, and the second preference is the retained earning. If you remember the entry for bonus shares, share capital credit, share premium debit, retained earning debits. So equity, one part of equity goes on credit side, other two parts of equity goes on debit side. Entry balanced means no impact, means no impact, zero effect, zero effect, nil effect, no impact. Other than that, all will have figures in form of dollars. All have figures like this, dollar, dollar, amount will come. But in the case of bonus, zero will come because bonus is increasing one part of equity while it's decreasing two elements of equity, and debit is equals to credit means no impact on equity, no impact on structure of equity because of issuance of shares. And company used to pay dividend. Dividend paid only. I used to say that we are taking dividend paid only. We are not taking dividend proposed. Halli dividend proposed. Ignore dividend proposed. We are not going to take dividend proposed. We will take only the dividend paid, and it will be given in the paper. The dividend paid will be deducted from retained earnings. Profit for the year. Profit is going to be part of retained earning. If it is a profit, it's going to be added in retained earning. Profit for the year. Profit is going to add in retained earning, which means total impact has plus. What if a company have a loss for the year? If profit is adding, if profit is going to be added, loss Instead of profit, if it is a loss, it's going to be deducted. And we remember either profit or a loss, both cannot be at a one time. Then revaluation. If value of asset goes upward, it's revaluation surplus. And if it goes downwards, it's revaluation deficit. If asset value goes upward, it will going to be added. But if the value of asset goes downwards, it can be deducted. Yani if revaluation goes upwards, yani value of asset goes upwards, it will be plus. And if the value of asset is downwards, yani value is declining, it will be minus. Sometimes company is transferring transfer from retained earning. If some companies, if company decided to transfer something from retained earning, it will be deducted from retained earning. And where it going to be transferred, sometimes the company is going to transfer from retained earning to other reserves from retained earning. And in your course, it will be only this from retained earning to the reserves. So you will deduct it from retained earning and you are going to add it in other reserves. Overall impact, one part of equity is declining, other part of equity is increasing. Zero impact. There are two zero impacts, one for the bonus and one for the transfers. A bonus and the transfers are there, there will be zero impact, no impact on total column, no impact on total equity. After doing that, after completing these columns, we are going to have the closing balance. The closing balance is the CD balance, closing balance. And this is the way, this is the methodology to make or to produce the statement of changes in equity.